Good morning, everyone. Thanks so much for hopping on to our second webinar of the year, how debt consolidation and credit education help drive broker success. I think we're going to jump right into it. I'll keep my eye on the attendees as they're coming on, but just for the sake of everyone's time, just want to jump right into it. I'm really excited to go through this presentation with you. I'm here with Eric Poblete. We've got a lot of great things to discuss with you. Really, the objective is to understand consumer debt trends and the impact to homeowners, how debt consolidation can improve mortgage refis, identifying opportunities to strengthen files early, gaining confidence in discussing credit with your clients, positioning yourselves as proactive mortgage brokers to win more deals. So that's going to be the key here. It's going to be a big focus of the presentation. But without further ado, I'd like to introduce Eric Poblete from Equifax Canada. Eric is a sales professional with over 30 years of experience working with all vertical markets. In the last 14 years, Eric has worked with Equifax Canada with a focus on the mortgage, rental, and housing industries. As the Equifax ambassador for the mortgage broker market, he's provided extensive support and education to all varied stakeholders, including brokers, lenders, underwriters, real estate agents, and insurers, helping them to understand credit, compliance, financial trends, and fraud directly and indirectly related to the mortgage market. So without further ado, I'd like to welcome Eric Poblete, and I'll let you take it away.
Thank you very much, Arlen. Oh my goodness, when somebody reads out my bio, it makes me blush a little bit. You might not be able to see it there. But thank you very much. In light with what Arlen was saying, I find that sometimes brokers and maybe none of the people on the phone, sometimes they wait too long to help their customers. And part of that is just not being aware of what they are, what they've got, and what's in their, I guess, in their financial portfolio. So what we're trying to do today is really try to be a little bit more proactive, understanding your customers, the situations that they're in, and over and above that, from a credit perspective, how to help them. In regards to, okay, I see where you're at. I know what your position is, but by doing these things, be it consolidation, be it whatever, just the credit management, you do have a way and a methodology to be able to support your customers. It's not magic. It's not, some sort of arcane thing in the background. You can actually do things to help your customers. But I'm going to just really suggest that being proactive, be ahead of the game, work with your customers. In some cases, I hate to say it, you might have to work with them, 6 months in advance because they've got themselves in a situation. But at the same time, there is a light at the end of the rainbow if you do work properly with them. And today, Arlen has invited me to talk a little bit more about the credit side of things. And then, we've got a few slides to share. I don't know if you're going to put up the deck there, Arlen, but,
Oh, you
that's
can't
a
see
little
the
bit of it.
decks.
Yeah, that's just a little bit of an intro in regards to, what we're going to be doing today. Logistically, I believe Arlen and I are splitting the duties. I'm going to do about 15, 20 minutes. He'll do about 15, 20 minutes, and we'll still have 10 or 15 minutes later for Q&A overall. So waiting
Give
on
me
the deck to come
one
up.
second. I'm so sorry. I
No, no problem. I was just
it's
so
technology. It only works well.
was that the right term? I was doing some filibustering, so I'm good.
Okay, so hold on one second.
And just for everyone's sake as well, the soft copy I have provided to Arlen, so reach out to him as necessary if you do want a copy of said presentation. There is going to be a lot of facts. I'll be honest with you, there's going to be a lot of facts on this deck, because again, it's all about education from my perspective. So what I'm going to do is next slide there. Do, 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 do. So first and foremost, one of the jobs of Equifax is also to provide information education, and one of that is also talk about what we call credit trends. I lost it there. It was up for a second and disappeared, Arlen.
So sorry. Give me one
No, no
second.
problem. So Equifax.ca, just so you know, if you go on the Equifax.ca, we do have an area where we actually provide access to quarterly webinars. So if you are interested, if you go to Equifax.ca and you go to market trends, what you'll see is we actually provide a quarterly update on consumer trends, commercial trends, and fraud trends. And it really talks about everything. It talks about, the mortgage industry, but it also talks about credit cards. It talks about auto, it talks about, all the different topics on financials, such as bankruptcies, um, debt, how much debt Canadians have, who has the debt, and what be the case. So keep that in mind. Again, your customers are looking at you as being financial experts. If you've been working in this industry long enough, you got customers that ask you, where should I send my kids to school, things of that nature. So really, you have to be up to date on the industry. And our market trends, we do have a lot of great information, and I do showcase a few of them. For example, we talk about consumer debt. The last quarterly trends that we had, and we do have another one coming up, I believe, at the beginning of March. We talked about how much money is out there. Uh, I do notice gambling trend, not specifically gambling, but we do have trends in regards to people's money, how they're spending, but not specifically to gambling. But over and above that, for example, we do talk about consumer debt. And we see, unfortunately in Canada, it's up $2.62 trillion in Canada. But over and above that, we also look at, even more specifically, those that have a mortgage and those without a mortgage. So we really want to trend towards saying, hey, what's going on? How much money are they using? And the unfortunate scenario we're starting to see is those without a mortgage are actually starting to approach a lot more of those with a mortgage, where those with a mortgage have been doing pretty good. Those without a mortgage, and these would be their new home buyers, they're having a bit of a challenge in regards to year-over-year change. So we do keep an eye on that. Next slide. Again, other information that you'll see in not only about delinquencies, but Equifax also provides information in regards to what we call the personas. What do I mean by personas? We can actually tell you, who's carrying the most debt by age group or even by provincial group. And again, this is outstanding for you, depending upon what your clientele is. You can start to understand, okay, you know what, if I'm dealing with younger Canadians under 36, they're actually carrying the most debt compared to the rest of Canadians. Some of this is intrinsic, some of this in your gut, this occurs. But over and above that, we provide the statistical information accordingly. For people, again, depending on province, Ontario, when we look at year over year in regards to debt, we're seeing that probably, outside of Alberta, Toronto and Ontario is really one of the areas where a lot of debt is being carried. And you know what? It's almost inevitable as prices increase, as inflation increases, the unfortunate renewal coming up where a lot of people are actually increasing their debt because their renewal rates are going to be a little higher. You are going to find a lot more people are challenged, and they're looking to the brokers and agents for solutions and ideas. And to that degree, as I said before, Arlen will talk a little bit about some ideas that can help your customers. Next slide, Arlen. Now, interestingly, as we go through this, as I mentioned before, we measured even to the minutia of, delinquencies as well, not just about the debt, but, hand in hand, we are starting to see delinquencies start to rise as well. And this is where your customers get challenged. I mean, especially in the Ontario region, again, with the challenges of inflation, higher prices on things, higher mortgages, and so forth, we are seeing year over year that their actual delinquencies are starting to go higher to that degree where it becomes a little bit of a precursor to, we're watching what's going to happen on their mortgage side. A majority of delinquency is usually typically cars and credit cards, things of that nature. Most Canadians are pretty dependable on their mortgage. But if you have a high delinquency rate, we inevitably see that this is going to start to bleed into mortgage. And to that degree, this is where, again, your customers are looking for, what solutions can I have? I've got all these different debts. I've got a car, I've got a loan, I've got a line of credit. What are my options? And to that degree, it is inevitable when we look at the numbers that this is occurring outstanding. Again, the other area is BC. Again, hand in hand with regards to higher house prices and then the renewal period being a little bit higher as well. Interestingly, if we wanted to start to look at, the data itself, what we also find is delinquencies are also, hitting new peaks, as I mentioned before, but really it's Ontario and Quebec or Ontario and BC, which are really starting to see the year over year increases on the delinquency side. Next slide. Now, one thing that is a bit of an opportunity, if you want to call it that, it's unfortunate, but this is the reality. One thing that we also measure, when we do our quarterly trends, is what we also call lender switching. So as time goes on and increasingly, and this is a good thing for the broker community, typically I state that the broker environment, are now involved in about 50% of the deals in Canada. Whereas in the past, if you were around 10, 15 years ago, you knew that the brokers only accounted for maybe about 5% of the deals. But we've gained such a great reputation. The opportunities are there. The unfortunate situation is the banks are not taking on a lot of, let's say small business owners and challenged credit. So to that degree, the broker community has stepped up. But what's happened, especially in the most recent past with the increases in regards to mortgage rates and costs, you have a lot of consumers that are saying, you know what? I got to look at other options. And to that degree, if we find that there is a lot of what we call lenders switching at renewal time. I mean, depending on where you are in the Ontario region, for example, we're seeing that about 32% of consumers are actually switching. And what does that mean for you as a broker, as an agent? Well, this means that there's a lot of activity. A lot of people are looking at their finances and trying to determine what should I do? How should I do this? How do I manage my debt? What other options do I have? And this is when they go to the brokers. And to that degree, again, as I mentioned earlier, this is part of the job of a broker and agent these days is to be that financial advisor, to look at all the different things, look at where a customer is in renewal, look at all their debt and say, you know what? I'm not your bank. I'm going to give you more of an objective opinion as to what you can do and how you can do things. And to that degree, it becomes more, in line with what the consumer is trying to do, as opposed to, I hate to say it, what the banks want to do from a financial perspective. So great opportunity and in these unfortunate times, but again, make the most of it and do the things that are proper. Next slide. So again, common debts, and this is more of an Arlen slide, but really these are a lot of the items that you do find on a credit file itself. Definitely revolving credits. These are all on a credit file. They're all ranked. We receive all the payments on such so that we know exactly how someone is paying. And certainly, I will talk a little bit later on the next slide about, what you should be looking out for your customers as far as what they should be doing as far as trying to help them improve their credit. But we do have a lot of the information on the credit file. Installment loans are also all in the credit file itself, which also are significant. A little bit treated differently, of course, because again, auto loans and so forth, typically, if somebody asked me that question, well, that's a high utilization. Well, they're a little bit different because auto loans are basically, excluded because they start at the full amount and then they decrease over time on a lease. Collections, absolutely. Those are part and parcel to credit files themselves because if you think about it overall, a credit file, credit scores really is trying to provide a picture of an individual to our customers, be it the broker or lenders. And to that degree, we have to have as comprehensive amount of data. And you know what? I know brokers only want all the good, positive stuff, but the reality is the lenders who are going to lend the money need to know the complete picture. And to that degree, sometimes, and it's unfortunate, but collection accounts do occur, but they are absolutely reported on a credit file itself. I will talk a little bit later about, timelines and purge rules, but definitely be aware that that's out there. Public records themselves and legal judgments, we also have on the credit file, bankruptcies, judgments, liens, proposals, and so forth. And you are going to find in this world, because I'm going to assume that people on this call are working with challenged customers, you are going to find that that is on the credit file itself. And really, interestingly, I do highlight to a lot of brokers and agents, you have all this information, but be very, very conscientious. The first word of advice I have to a lot of people as far as improving credit file, first word of advice I have is always saying, making sure the credit file is accurate. It's unfortunate, but I've had a lot of customers who've had, let's say, proposals, but then when you look at the credit file, it actually doesn't reflect what is on the proposal. And to that degree, I've seen many, many consumers lose 100, maybe 150 points just because the credit file was not accurate. We do our best at Equifax, but we are reporting over 30 million Canadians, millions of bits of information literally every day. So certainly we want to fix the credit file, but this is where the broker and agent shows their worth. If you are able to proactively look at the credit file and first and foremost make sure it's accurate, you are really doing your best to assist the customer and making sure they have the best score as much as possible. So that's my first word of advice. When people always ask me, how do I help my customers? First and foremost is always improve or always make sure that the file is completely accurate. Next slide. But I will get a little bit more into the minutia of the credit score itself. And please bear with me, but this is really important, not just for your customers, but also for yourself. You know, the credit score itself is really about measuring how well does someone manage credit. And it typically falls into five different categories: payment, utilization, history, new, and basically credit, what's a portfolio. And I'm going to start first and foremost with payment. I'll give a few tips and hints as well, by the way. This is about helping your customers improve their score. Payment, when you look on a credit file, these are all those ones and twos and threes. And basically, it measures, are they paying on time? Or are they paying 30 days late, 60 days late, 90 days late, or what be the case? So first and foremost, because it's a credit score, the payment part is the most significant part as far as waiting. Easy advice. I mean, it's easy on the surface. I know it's hard from a realistic perspective, but just always pay your bills on time. Okay. Even if it's a $50 bill, don't let it lapse into I'll pay it next month type scenario, because then your lender will report that as a two, which will affect your credit score. So always pay at least the minimum, because if you pay the minimum, you are paying according to terms. And to that degree, you want to maximize that payment component. I mean, the ideal customer is really a customer with all ones across the board. And to that degree, the model looks at that person as saying, hey, maybe they're paying all of it, maybe they're not, but they are conscientiously paying their bills. So to that degree, they'll maximize that component. But this does segue into the second part, which is called utilization. And this is really an interesting animal because I've had chats with Arlen, and this is where the delicate balance is in regards to when you do consolidation and so forth. Utilization is what I call the silent killer of credit scores. You know, you could be paying all your bills on time, but if your utilization is too high, 80, 90, or 100% of your utilization is being used month after month, you could lose 100 to 150 points on your credit score. So really, one of the goals that you want for a customer when they want to improve their score is get your utilization down as quickly as possible, as much as possible. And if it means doing things like consolidation and so forth, that is a potential that you can do, but certainly make sure that they manage the credit, because the one thing you have to be conscious of, and I do advise a lot of people. Sometimes people ask me, should I increase my credit limit? And you know what? In a general mathematical sense, yes, that's a great idea, because when you look at the ratios, increasing that number actually can help you to reduce your debt load, and to that degree increases your credit score. But my warning is, be disciplined. Just because you got an extra 10,000 on your credit limit, if you spend it, you actually are in a bigger hole. So again, remember, credit is about how you manage credit, not how much you have. So if you're looking specifically at the credit score, make sure that you do the best you can on utilization, increase it if you can, but be conscientious and use it appropriately. History on a credit score, this is kind of a little bit interesting. And history is like the score stabilization. How stable is your score? And if I look at, myself or Ireland, we've been paying our bills for years and years and years, and we pay it on time and paying it well. Think of it as a credit boat. So as a credit boat, every year I build my boat bigger and bigger because I'm paying all my bills. What does that mean? If a wave hits my boat, and the wave would be likened to a missed payment or a high utilization, well, guess what? If I'm in a big boat, I don't feel that wave. And as such, it means my score does not get affected much, if at all. But I will mention or warn you, though, if you're in a small boat, if you're new to Canada, damaged credit file, young couple, student, that type of scenario, that same wave hits your boat and you feel it. That means that, that same thing where it's just let's say one inquiry could affect their score 20, 30, 40 points. So be aware when you're working your customers, especially those that have challenged credit files, everything they do is accentuated, because really, again, the model's looking at the data that they have available to that person. And if a lot of that information is negative, then it will affect them more greatly than somebody who's got a big stable boat. Credit on the top 10% of your score is about credit. It's like, what do you have in your portfolio? And the warning I have for people out there is, don't have too much. If you have too many of anything, and most people, the worst culprit to this is like retail credit cards. If you got that customer who's got just too many credit cards, that will start to affect the model and the score, because the model says, hey, this person's credit seeking. This person needs a lot of credit cards. I don't know why, and it's not really necessary. And to that effect, it can affect your score up to 10%. So be aware and conscientious when you have a customer with too much, that can affect their score. But word of warning, if you have a customer, sometimes brokers say, hey, let's just cancel all your cards and that's going to help your score. That's not always correct. If you had a customer that had a credit card and they paid it well for the last 10 years, it's got $15,000 limit on it. If you eliminate that card, if you cancel it outright, you have the potential that the payments, the history, and even the utilization will disappear. And as you can see, that could actually affect the credit score negatively. So just be very diligent when you're advising your customers about what they're canceling, what they're not canceling, what they want to keep active, because that can affect their score overall. You have to make sure you are aware of that. The new part, this is the last part I want to talk about, is really about inquiries themselves. And we know this, people who have been around for a while know this as hard inquiries versus soft inquiries. I just want to delineate between the two. So a hard inquiry is every time you pull a credit file because you plan on giving them something of value. It could be a credit card, it could be an auto, it could be a house, a mortgage, what be the case. So definitely too many inquiries can affect a credit score because again, the model looks at you as credit seeking. You're just asking everybody for money, and maybe that's not a good thing. But I do want to emphasize in the mortgage space, and this is one of those myths I want to dispel. We work with a FICO 8 score in the mortgage space, which is called a shopping model. So keep this in mind because what happens is, as a shopping model, all inquiries related to mortgage within a 45-day period are actually treated only as one event from a scoring perspective. So even though there may be multiple inquiries that occur in during an event of a sale or a refinance or what be the case, they all get treated like it was just one event, so it does not hurt the customer's score or has very minimal amount of effect. So keep that in mind when you work with customers because you are going to be dealing with sensitive customers, very sensitive to all the things going on because maybe they're already in a financial situation. But be aware that in the mortgage space, again, we use a FICO score. Yes, all the inquiries will be posted, but really it will affect your score within a 45-day period as if it was just one event, even though there's multiple events overall. I believe I'm going to hand it over to you. That was sort of a little bit of an overview of credit itself. And what will happen is Arlen will start to bring some of the pieces together based on what I've told you in regards to what he's looking at, promoting in regards to some of the consolidation. Next slide, I think, is yours, Arlen.
Yeah, yeah. So, Eric, thanks so much. That was such fantastic insight. Really, this data shows us the state of the market right now and really what our clients are dealing with day to day, and the opportunities that are present in the market for mortgage brokers and agents. And this is really going to take us to the second half of the webinar, as you mentioned, where I'm going to be discussing debt consolidation and how you can leverage debt consolidation to help drive broker success and really light a fire under your businesses, especially with the slew of mortgage maturities coming up in 2026, but really taking the tools and setting yourself up for success long term beyond just the slew of renewals coming up this year. So I guess let's start with the basics. What is debt consolidation? It's strategic restructuring of high interest debts into one simple payment. It helps improve cash flow and ratios in many cases, simplifies the credit profile, as Eric was mentioning throughout his part of the presentation. And ultimately, it's beneficial for clients as a pre-mortgage optimization tool. And that's something that I'm going to be talking about throughout the presentation. And that's really a big highlight that we want to be focusing on here. So first off, why structuring debt matters. Eric did a fantastic job. He spoke about a number of these points, so I'm just going to talk very quickly about it. But high interest debt impacts affordability. It's clear. The more that your clients are paying out of pocket for high interest debt, the less money they have for other things, food, gas, clothing, anything else. So keeping more money in their pocket is obviously beneficial to the homeowner. Multiple payments complicate repayment. So if clients are juggling multiple credit cards, multiple due dates, it's a higher likelihood or a higher chance that these clients are going to be late at making payments or miss out on making payments. It could be an affordability issue. It could just be missing out on the dates and not having the organization of when things are due and when clients need to be paid. So there is higher risk when there are multiple payments, it complicates things. And then high utilization, as Eric mentioned, impacts credit scores, which ultimately impacts mortgage pricing and lender options. So how debt consolidation can strengthen a mortgage file? Well, as I mentioned in the last slide, usually lowers homeowners' monthly obligations. If we're able to debt consolidate at a lower weighted average interest rate, there's more money in the client's pocket, which means that they've got more money for things like food, clothing, or anything else. It helps to reduce utilization over time in many cases. It helps to clear and clean up debt structures, so improving the lender confidence over time. Consolidating debt, making a credit report much more simplified, creates a cleaner profile for the client and gives more confidence to the bank. It allows more approvals, often better pricing, and it has fewer last minute issues, which gives a client better experiences. So I'm alluding to being proactive, which I'll get to in a couple of slides. But beforehand, I just want to talk very quickly about when consolidation might not be the right fit. So it all sounds fine and dandy, and for many clients, it is a saving grace, but it's not right for every single client. And that's really your job as a mortgage broker agent to determine the clients where it will be helpful and where it wouldn't really work in various scenarios. So you're looking at things like low or unstable income. So clients that are just living beyond their means, spending too much. These types of clients, it's very difficult and isn't the right thing for debt consolidation because regardless of where you're consolidating, there's really no plan moving forward. So you got to be very cautious about low or unstable income when you're looking at your client's income potential. And tackling that's another conversation to be had if they are and you are deeming your clients to be spending beyond their means. If they're business for self and it's unstable, getting a better understanding why that client's income is unstable. Maybe there's a solution, maybe there isn't, maybe you just have to wait, maybe their income is seasonal. Again, that's a conversation that you have to be having with your clients to get a much better understanding of their profile. When LTVs are too high, so right now, I'm sure across the board, we're all seeing appraisals coming in much lower. Clients think that they've got more equity than they do. Appraisals come in, and in fact, there isn't as much equity as they once thought. So when loan to values are too high, it might not make sense or might not be feasible for lenders to provide debt consolidation as a second mortgage for these specific clients because the LTVs are just too high. The biggest one here is no clear exit plan. So it could be for a number of reasons. Maybe they're living beyond their means, or their credit is their income's unstable, or there's many other factors that deem why there's no exit strategy. This is the key. We need to make sure that there's a crystal clear exit strategy if we're going to be doing debt consolidation. And the reason is ultimately this is a pathway for you to clean up a client's profile and get them back on their feet and where they need to go. I'm going to be talking about being proactive, which is really the core of this whole conversation about debt consolidation and how you can set yourself up for success. But it all starts and ends with a clear exit plan, because without a clear exit plan, it may or may not work for the client. So why it pays to be proactive, it is really the core of everything I'm talking about here. Being proactive is not only going to set yourself up for success, it's going to make you way more successful in your mortgage business, leveraging debt consolidation or any other product that you're offering to your clients. So it pays to be proactive specifically with debt consolidation. We all know that there's a slew of renewals and mortgages coming up for maturity in 2026 and beyond. So learning these tips and tricks are pivotal right now for you to be successful for this year and beyond. So first off, being proactive, it shows your clients that you really do care. It also adds a relevant touch point and starts the conversation ahead of these renewals. So it doesn't matter how you're doing it. I'm going to make some recommendations in the next couple of slides, but adding this into your tech stack, whether it be through your CRM, making simple notes, maybe it's through AI automation, whatever platforms you use to be successful in your business, leverage these touch points and calling your clients or contacting your clients about debt consolidation. I'd like to use two examples. There's two real scenarios where these debt consolidation conversations can go. The first one, I like to use the example of a lottery winner. They're not necessarily winning the Lotto Max, but I like to classify these Lotto winners as clients who are in good financial standing. They're living within their means. They're not overutilizing their credit. They're in a good financial position. These clients may not be the right and suitable for or need debt consolidation, but they are beneficial. One, it shows contacting these clients out of your typical process is 6 months, 8 months before their first mortgage comes up for maturity, it's showing that you care. Just a quick, hey, I'm contacting clients, helping a lot of them with debt consolidation. I just wanted to give you a quick call. You're likely not expecting to have a conversation with me for another year, 2 years, whatever the case may be. But I just wanted to say hello very quickly or send an email. I'm scheduling meetings, whatever the case may be. And if they say, hey, thanks so much for the call, I don't need your services. I'm in a great position. I actually just got a raise. Life is great. Thank you so much. Well, it's showing that you care and you're also being proactive, and you can make notes in your CRM. Client didn't need things, living within their means. You can make the assumption that their credit profile is around, if not better, or around where they were when you did their mortgage. So you're really setting yourself up for success, and you're providing yourself some peace of mind that that client's situation hasn't changed drastically since you did their mortgage. On the contrary, you've got the client that's struggling right now. Maybe they have gone through an illness themselves, or taking care of family members. Maybe there was a job loss, or some other things that changed where they are in the process, and they're spiraling right now. If they haven't contacted you, they're likely burying their head in the sand. Maybe their lines of credit are maxed out, their credit cards are maxed, and they don't know how to get out of this. Well, contacting them and providing them peace of mind that you potentially have a solution through debt consolidation is a great way for you to action that right now proactively, provide peace of mind both emotionally and financially to this client. And it will ultimately set them up for success moving forward. So, generating, on the one side, generating referrals from the clients that don't need debt consolidation. You're being proactive in contacting them well ahead of their renewal. It shows that you care, but then you're also able to generate referrals, which is the best form and the cheapest form of generating leads, through clients that have worked with you in the past, that trust you, that care about you, and now they know that you genuinely care about their financial and mental well-being when they call you about debt consolidation. So another very important factor here is being proactive on the client side of things. So educating your clients about free credit pulls with Equifax and TransUnion. Equifax. So this is a great tool for clients to use. It's a soft pull, so it doesn't impact their credit score. They can do it as often as they want. Rule of thumb, and Eric, maybe you want to step in if I speak out of turn, but somewhere between every month, every 2 months, something like that, just to get a sense of where their credit is, so they have a foundation or a baseline of where they are today, where they're going tomorrow, but also looking for fraud. Before I move ahead, Eric, is that kind
Yeah,
of a
yeah.
good
No,
rule
no,
of thumb?
absolutely. You're absolutely correct. Our current services today, you can actually pull your credit file online, no charge. Once a month is what we typically say. If you do it twice, I don't think anybody checks on that. But certainly you want to keep an eye on your credit file, as mentioned by Arlen, with fraud, because there are a type of fraudster that actually will infiltrate your credit information, but not action on it for months on end. They'll actually build credit within your credit file, and at some point in time, they're going to just charge something for 20, 30, $40,000 and then disappear. So, a good thing to protect your customer is for them to always make sure that, at least every 6 months, look at your credit file and make sure that it's accurate and everything's on there, because really you don't want to be caught later on trying to, talk your way out of that's not me and all that type of scenario. And by the way, directly from Equifax is only one methodology that you can do it. There are many other ways, I'll be very candid with you, the Borrowells, the Credit Karmas. There's a lot of different tools that actually do provide credit scores as well. I think the end result is, as Arlen's trying to get to, is be proactive and understand credit. Don't just sort of, magically surprise yourself at the end of the deal, or towards the end of the deal. Be aware of it, be conscientious of it, and protect yourself, because these days there's a lot of fraud going on. And, one of the key things is protect yourself by knowing your credit information. Sorry, Arlen, go ahead.
Yeah, no, great. Thanks for the support there. Yeah, so we all know, obviously, see the benefits of being proactive versus reactive. So where are some common use cases that you can look at and start supporting your clients proactively? Well, the very obvious one for 2026, with the slew of mortgages coming up for maturity this year, are pre-A and B lending optimization. So if when you're contacting these clients of yours, you want to plan ahead. If you know when their maturity dates are coming up, so contacting them well ahead so you can be optimizing the success and providing the clients with as much option as possible when you are looking to refinance their mortgage. If the client does need debt consolidation, pre A and B mortgage planning is very, very important. Really bridging that client through their credit repair, and providing that financial support so you can both set each other up for success. And it really changes the conversation from, hey, my bank offered this renewal rate, can you beat it? You're really changing the conversation, and taking it away from just a rate conversation into a solution focused conversation, which us, you guys as brokers is really where you want to be in the conversation. So consolidating ahead of renewal, as I've mentioned, obviously it's super important to be proactive doing it that way. But other people have other scenarios and other needs for debt consolidation. Maybe their mortgage, you just did their mortgage, something happened 6 months after you closed, their mortgage isn't coming up for maturity for a number of years. So there's a number of other situations and scenarios like CRA debts, property taxes. Maybe they just finalize the judgment or any other big expenses that would allow or make sense for a client to take on a debt consolidation. So it's not just looking for renewals; it's a number of different factors. Any sort of big expense that is impeding on the financial stability or the credit success with a client. Divorce, separation, life transitions. Whether someone has an illness, for example, or they are responsible for taking care of a loved one and they're not able to work, or that's just their focus for the time being. Maybe they're working part-time, just whatever their scenario, life situations. A million different scenarios can happen, but these are some use cases where you can look to support your clients. Obviously, self-employed homeowners, they may have some strong equity in their property, but unstable or lower income this year. Maybe the economy or the industry that they work in has been impacted by the tariffs, or maybe it's a seasonality job or profession that they're in. So every client is different, and really just having these conversations are very, very important for you to be successful and for your clients to be successful. But at the end of the day, being proactive and having these touch points throughout the year, throughout their mortgage journey, whether their mortgage is coming up for maturity or not, we never know what's going on behind closed doors. We don't know if a couple is getting separated. We don't know if someone is ill, lost their job, or something else. So having these ongoing touch points for your clients, it makes it a very legitimate way for you to just check in, show that you care, and really be that financial support system for your clients, so you can look like a superhero, nurture that relationship with the client, and really be that person that can lead them to success with their mortgage and financial journey. So I just want to show you a scenario very quickly, just so you can see the numbers. I'm sure a lot of you have dealt with debt, but there are a lot of you on the presentation right now. So I just want to talk about a real life situation here where we've helped free up some cash flow, helped a client increase their credit score, and kind of handed it off to the mortgage broker to get them back on their feet and where they wanted to go. So we had a client here through Tembo Financial, single client living in the GTA. Their credit slipped from the 700s down to 615. The goal of a debt consolidation here was to lower monthly payments for the client, improve credit, and have the broker refinance the client at maturity when their first mortgage came up for maturity. Their utilization was high. The broker couldn't get the client a HELOC with the current bank that they were with. So here are the numbers. The client had 2 credit cards, a line of credit. So on the surface, it didn't look like they had multiple lines of credit, multiple credit cards. So from a credit profile, if you just looked from the top level, it may have looked like, oh, they're in a decent financial situation. But when you really look down into the minutia, they were overutilized and spending a lot more money than they wanted to on high interest debt. So they had 1 credit card that had a balance of $38,000 at 21.99%. They were paying about just under $700 a month. They had a second credit card at $12,000 paying just under 20% interest, which is about just under $200 a month. They had a line of credit that had $22,000 on it that was well overutilized at 11%, which is about just over $200 a month. So they had total debt of about $72,000 and paying monthly payments of about $1,100. So the cash flow is tight for this client, and we wanted to help them out. So the situation that we put together, we gave the client an $80,000 debt consolidation loan. We structured this as a second mortgage. It was a 1-year term. It helped reduce the utilization on these credit cards and their line of credit significantly. We saved the clients $365 a month, which equated to an annual savings of $4,380 a year, which for many homeowners, that is a quite significant savings. As I mentioned earlier, it was a 1-year term. Their broker, because of this solution, because we were able to fix and support the utilization here, that client was able to work with their mortgage broker and to pay out the second mortgage when they refinance their first mortgage at maturity. So that's a key here for you. It's a big opportunity and the lights are buzzing. So again, their mortgage came up for maturity. If they didn't need debt consolidation, you're competing against the banks with competing with their rates. From what I've heard from many broker partners that we work with, the banks are being very, very competitive right now and trying to undercut the broker channel, which it is what it is. But when you're finding solutions like debt consolidation, you're setting yourself up for success and changing the conversation from just, can I compete on rate, to being solution focused, where in this case, the broker wasn't competing against the rate because the client couldn't just go and renew their mortgage. They had a second mortgage that they had to deal with. So in this case, the client and the broker worked together. The broker worked the partnerships and the connections that they have with the banks, and they were able to refinance this mortgage and consolidate the first and the second mortgage. And it really helped this client get back on their feet and where they wanted to go. So how Tembo Financial supports brokers. So we are a direct balance sheet lender. So we're not a MIC. We don't syndicate any mortgages. We have our own funds ready to deploy. So we like to work with brokers. We want you guys to be the superheroes in the story. And we just want to be a shoulder to lean on when you're working with clients. We know, as I mentioned earlier, debt consolidation isn't right for every single client of yours. But if you're unsure of where it works and where it doesn't, pick up the phone, send us an email. Our whole team loves to chat about deals. We love stories to understand where the clients are today, where they're trying to go for tomorrow, and we can customize solutions because we have our own internal funds. We can customize these solutions to fit these client scenarios, whether it's leveraging prepayment, leveraging principal and interest payments, whatever the case may be. We can provide flexible solutions that will help get your clients where they need to go. All of our pricing is 100% transparent. We've got extremely low all-in legal fees. So there's no surprises for you. There's no surprises for your client from origination to payout. That way we can offer a client a sound, transparent, and clear solution that will help get them where they need to go. Making the broker or agent look like an absolute superhero. So just talking about next steps so you can set yourself up for success, you need to identify clients who may benefit from consolidation. My biggest my biggest suggestion for you is just to pick up the phone. Have fun with it. Have these conversations with clients. For clients that don't need debt consolidation, it's a good touch point. It's a very quick conversation. You can make a lot of conversations throughout a given day. So if you're looking for excuses to connect with clients, just to remind them of who you are and what you can do, how you can support them, pick up the phone. Emails get buried a lot of the times, or maybe do both. Send an email saying, hey, just wanted to say hello. I'm going to call you this week. And then you pick up the phone and you have that conversation. For people who are struggling, I've found it's much easier to hear the stress in their voice. And then you can see the seriousness and gauge how serious these clients are. And then that way you can kind of calm their nerves, and you can provide that peace of mind in a much more personable way rather than just sending emails back and forth. Ongoing client check-ins will allow you to be proactive. So again, it doesn't matter what your process is. I know that there's a lot of you on here, and all of you guys have different ways to be successful. So add it into a calendar, into a spreadsheet. If you're using more of an old school method, set up follow-up reminders for yourself in your CRMs. Use AI, whatever AI platforms you use, to either reach out to clients or set reminders for yourself. But AI is a fantastic tool nowadays, and they're coming out with new products every single day to support your business. So leverage all these tools to set yourself up for success by being proactive. Use credit insights to guide these conversations. So position consolidation as planning and not rescue. So again, going back to being proactive, you want to plan ahead, not contact a client a few months out before their mortgage comes up for maturity, and then you're rescuing this client. You want to talk about you being an expert in planning for success. Which will give much more a stronger peace of mind to your clients than saying, hey, we got to rescue this, otherwise this and that and whatever is going to happen, which isn't usually ideal for the client. So encourage clients to check their credit scores often, usually every month, to avoid any sort of fraud risk, but really just so they have a baseline and understand where their credit is on an ongoing basis. And then suggest, if they see the credit slipping, to give you a call so they can help themselves be proactive. You guys have big Rolodexes, big books of business, lots of clients to connect with, and you're busy day to day. So I don't expect you to focus entirely on debt consolidation and all of this. But if you can add these touch points in, you're going to help yourself. But if you can encourage your clients to be proactive and pull their credit score, they can also help themselves as well and be proactive on their end. And then it's a two-way connection when you're going out to be supportive for their financial and mortgage well-being. And again, if you ever need us, engage Tembo Financial early for any sort of strategy support. We know and will decline the deals that don't make sense. Our whole role is to make sure that the debt consolidation will help get the client back on their feet and where they need to go. If you're unsure of what that looks like, give us a call. We can underwrite files in an hour and provide deal feedback within the same morning or afternoon that we connect, usually over the phone. It'll help you provide some clarity to your clients quickly, and we can get the ball rolling if it does make sense. So feel free to engage us. I leave my contact information at the end of the presentation. Keep it close. Feel free to call me at any time. So key broker takeaways here: structure matters more than balance. Okay, make it simple to succeed. If you understand what impacts credit scores, how you can help your clients with debt consolidation, and just keeping them financially afloat, and setting them up for success early on, you're going to allow them to succeed. It's going to change the conversation from prices to solutions, which is where, as a mortgage broker and agent, is where you want to be. You're an expert in what you do, and show your clients early on why it makes sense to work with you rather than taking the automatic renewal with the broker. Early planning provides better options. So the earlier you are, the more proactive you are, the better chance for success, which opens the doors for way more options with banks, better pricing, and a number of other things that you all know much better than I, when you start planning early and having A plus client going and getting the best option for them. Credit health is a part of readiness. It's one of the most important factors to provide those open doors. So again, make sure that your clients understand how credit impacts their success. And most importantly, call your existing and past clients. Please, please, please. Your business is going to thank you. You're going to thank yourself. It's going to set you up for success. It's going to show your clients that you care, and you're going to be much more successful long-term helping these clients with debt consolidation and other tools to be successful long-term. And again, incorporate touch points throughout the mortgage journey on an ongoing basis, whether it's every quarter, every year, whatever works for you and your clients. Make it happen. Pick up the phone, send those emails, schedule those coffee dates, and just make it happen. So before we wrap this presentation up, there's been a lot of information, so I'm sure that there's some questions that you guys have. So Eric and I are here. I'm just gonna check the chat here to see if there are any questions. A lot of AI. Eric James Stanton asked about gambling trends. Is there anything that Equifax has
Yeah.
published regarding gambling trends?
Not specifically. So we'll have to keep that on the horizon. We have been working with a lot of gambling companies, but a lot of the work we've done at Equifax is about authentication of people, making sure that they're not fraudsters, making sure they're not, money launderers, things of that nature, making sure they're of age. I mean, to be honest with you, when people are gambling, we have to actually validate age and so forth. So that information, we are working with a lot of those institutions and so forth, but specifically about the gambling trades and such. Not as of present. That's a bit of a tricky animal, to be quite honest with you.
Okay. Someone asked if this is going to be recorded. Yes, it is being recorded. I can see if I can send it out to all the attendees, but if not, then I'll likely publish it on YouTube or something so you guys can have it. Just do me a favor, whoever asked that question or whoever's interested, just send me an email. So if for whatever reason I can't send it en masse, I can send it out to you all individually. Or at the very least, I can just send you the slides. Next question. Someone mentioned about a big trend with public record section discharges with ministry, i.e., auto loans are not updated. Some don't have a trade line to cross check with it.
Yep, yep.
Um,
So that is a challenge. As I mentioned earlier, when we do find, because certain entities, judges, lawyers are not obligated to report to Equifax, this is why I highly emphasize that anybody that's working with a customer that's had a challenge, first and foremost, make sure the credit file is accurate. We do want to fix it. And if you do it early enough, I mean, the consumer can do it for free. You don't have to escalate it. You can actually have it do it for free if the consumer opens a dispute, provided they have all the necessary proof. Again, it is challenging with the millions of bits of information, but we do want to make it accurate. But again, if you have a customer that's gone through challenges and it's not a straightforward credit file, highly recommend that you become the hero, review it, and then help them get through it. As far as the escalation goes, if you are doing a mortgage escalation, it is chargeable. And what you do is you contact our GBS department at 1-877-227-8800 in regards to opening up a mortgage escalation. And I will put that in that phone number in the chat box.
awesome. Someone else asked, so as long as clients are paying minimums, it won't adversely impact their credit score.
Well, as I mentioned earlier, the segue to that though is if you only pay the minimums, your utilization does start to increase. And unfortunately, high utilization can actually impact your credit score. So that component will be maximized in regards to the payment part, the 35%, but be conscientious that it does affect the other one if you continue just to increase your balances year month after month.
Okay. Is the shopping model specific to mortgages only, or does
Oh,
it reflect the
yeah,
same
I
on
actually
autos?
answered that. Yeah, I actually answered that. There is a shopping model in auto, but that's only a 2 week period and it uses a different score. So yeah, Arlen, I did answer a few of these questions as well, but continue on.
Yeah. What is the creditor's obligation in reporting to Equifax?
Continue on. Yeah, just to reemphasize, all lenders report to us minimum of 30 days. Some report twice a month, but as a minimum, they have to report to us at least once a month.
Oh, sorry, I see that you are responding here. Yeah, didn't get
No,
to
no,
your
no problem.
responses. Okay, that's you.
Reemphasize the
Um,
point.
any consideration on holding lenders accountable for their mistakes and lack of appropriately timed updates? I have
Yeah,
so
that's a
many where
tough
the
animal. Yeah, we do have thousands of lenders and we do hold them to a QA, quality assurance. So we do want to advise them. We want the data, but certainly, if we ever get to a situation where a lender is always inaccurately reporting, and I hate to say this, sometimes the collection industry is one of those animals where they report only negative information and not positive information, we will actually decertify or basically take away membership of some lenders. So this is why you may actually not see a specific creditor credit collection agency on an Equifax file is because we did not find that their information was always timely or accurate.
okay. There was a comment that would be great to provide clients 2 to 3 free updates, inquiries on their Equifax account as there's an active dispute. The monthly is expensive for many. For me, worth it, but for many, it's just another expense for those struggling. So, um,
I'm not sure what you mean by monthly, and I apologize on that one.
I have a client. David, that's specific. I would contact the number that Eric added. He
Yeah.
commented on
So
that.
so yeah, just folks, everybody, the GBS number I've got in the chat box, 877-227-8800, is absolutely your go-to number because they also have access to credit file information. So if you actually have a very specific question in regards to a consumer or a very specific credit file, they would actually have access to it. So they would be your go-to for any question, billing, credit, whatever be the case. Typically, you'd reach out to me if it's been escalated or if you need an escalation, but in most cases, our GBS team is really the whole team that really handle all your queries.
This is, I guess, a question for me. I don't know if you have any data on this, but what is the average consolidation amount? There's really no average. I mean, we've got clients that are looking for $30,000. We've got clients that have hundreds of thousands of dollars of debt. It really depends on what they're paying out. If it's credit card debt, it often tends to be a little bit lower. But if there's consumer proposals or bankruptcies that they need to pay out, or business taxes, it could be quite significantly depending on how much money they've claimed and how much taxes they owe. So there really is no average consolidation amount. It really depends case by case. Um, there is a question here. How much does CRA judgment affect credit score?
So as I mentioned earlier, there's so many different effects in regards to, if you have a stable credit file, if you've got a long one, if you've got all these different trades and so forth. So there's not a specific number that says, okay, a CRA will be this much. It really will depend upon a lot of the other factors. Unfortunately, any negative information will affect the score. But as I mentioned earlier, a thinner file will have a greater exaggerated effect versus somebody who has a thicker file.
Awesome. Eric, what is the broker escalation process? Where do we find this? What
Yep.
documentation is required?
I provided
Uh,
the phone number. That's what you
yep,
need to do. Just reach that phone number.
yep, cool. Purging. Does Tembo have a platform for estimating quotes? That's a great question. We underwrite everything on a case by case basis. I have very top level pricing, but I strongly urge you to give us a call because we can turn answers around in an hour. We can price out specific files much more accurately than just you going based off of our rate sheet. So, Darlene, thanks so much for that question. Just pick up the phone, give us a shout. Pricing really depends on credit score, location, a number of different factors. Um, Thank you. Why the companies are not bound to discharge the loan when paid and when they're allowed to register charge on Equifax? I don't know if that's something we can answer. Uh, Another question here. What else can be done for clients exposed to fraud? I have a client who still has credit files open often, and the file is marked as fraud or client comments were added. It hasn't helped. Anything else they can do?
No, again, the key thing is contact our 800 number because we do have different departments that handle fraud specific issues. And absolutely, it should be, if it is identified as a fraudulent activity or data, we will purge that information and change the score effective as of when we remove it. So keep that in mind. We are very conscientious. We only want correct information. If for whatever reason you consider a fraud data is still on your credit file, then for whatever reason it hasn't been proven as fraud, and any material you have, police reports or what be the case that can assist us, we definitely want to improve upon that, but we need your help because again, I'll be very candid with you, and many people have dealt with many consumers. Sometimes they say it's fraud, but it's really just a consumer lying to you. So we have to be very conscientious that it has to be accurate.
Awesome. Since we're running out of time, I'm just going to go two more questions. One is a conversation that you and I had, Eric. Why don't we see all lenders reporting mortgage payments to the Bureau? I believe EQ Bank doesn't, for example.
Yeah. Well, so just as a quick note, Equifax absolutely wants to, but there is no actual specific mandate for everybody to report. There's no law that says that. There is a benefit to it, and we're trying to convey that benefit to the lenders because, quite bluntly, if you are reporting mortgages, in most cases, mortgages are positive information. Most people pay their mortgage. And to that degree, it actually helps to improve credit scores. So Equifax underwent a new process to make it easier for lenders to report. And all we could suggest to all the brokers out there is tell your lenders to contact Equifax and say they want to report, because it really will help the whole industry overall to get more information and, quite bluntly, help your consumers improve their score. So there's no limitation, but there's also no law obligation that they have to.
Okay, and then last one. I mean, this is a situational example. Do you think paying off collection payments are doing more harm on bureaus rather than not paying off?
If you want the Equifax comment, pay off all your debts and then improve your score is really the Equifax commentary for the best credit health. But definitely it's a balancing act. I will make mention, and I will say it because it is a fact. Negative information on a Equifax credit file does fall off after 6 years. So if you've got debt issues, you might time it accordingly, but I'm not saying that you should or shouldn't. I'm just giving you the facts that negative information falls off after 6 years.
Awesome. Well, I think that's all of the questions that I can see. Um, Thank you guys. Thanks everyone for hopping on. If you have any questions whatsoever, I put my contact details there. I left Eric's email. I should put that
Yeah.
number. I wasn't aware of that number, but Eric put it in the chat.
Yeah,
Once again, for everyone, it is, I'm loading it up. Sorry, give me 1 second.
I've typed it in before, one eight
One,
seven seven 227 8800.
perfect. 1-877-227-8800. If
Yeah,
anyone
thanks.
else has any questions, feel free to give us a shout. Thank you so much for your time, and hope you all found this valuable. Have a great day,
Thanks,
everyone.
everybody. Take care.
Take care.